Arizona is experiencing one of the toughest corrections in the American real estate market today. High interest rates, soaring home insurance, falling accessibility, and oversupply in major hubs. From luxury condos in Scottsdale to family neighborhoods in Mesa and Gilbert, prices are giving way, projects have been frozen, and investors have retreated. In this video, we show the 8 cities where the price drop gained strength in 2026 and what this means for buyers, sellers, and investors. If you want to navigate this storm with data, strategy, and real opportunities, subscribe to Keynomics now and hit the bell so you don't miss any market movement. For years, Arizona was the American dream. Wide open land, expanding cities, and homes that seemed like an escape from the chaos of California. But in 2026, that dream is cracking. From the sprawling suburbs of Phoenix to the mountain retreats of Flagstaff, the Arizona real estate market faces a brutal reckoning, driven by high mortgage rates, a collapse in affordability, insurance shocks, and overbuilt developments that no longer have buyers. What was once the hottest market in the country has cooled. Builders are freezing projects, owners are cutting prices, and the investors who once flooded the desert are silently retreating. This is Discover the Nation, and today we are counting down the 8 Arizona cities where home prices will plummet in 2026. Stay with us until number 1, because the city leading this collapse might surprise you. Number 8, Flagstaff. Well above the desert floor, nestled among ponderosa pines, Flagstaff was long seen as immune to real estate downturns. A mountain escape fueled by universities, tourism, and second home wealth. But now, even this alpine sanctuary is shivering under the chill of a market correction. After home prices surpassed $800,000 in 2022, the Flagstaff market is in retreat. Average values have fallen 17%, and local agents have warned that the slide may continue throughout 2026. The problem is the classic affordability collapse. Wages did not keep up with costs. Even dual-income families earning 6 figures struggle to qualify with 7% mortgage rates. A modest $600,000 home now costs over $5,000 a month to maintain, before insurance, before taxes. The city's advantage as a Zoom town, a city that grew with remote workers, which was once its superpower, has vanished. As remote workers are called back to Phoenix, LA, and Silicon Valley, the very migration that inflated Flagstaff's market has reversed. Empty Airbnbs now outnumber active long-term rentals. Short-term rental owners, once the lifeblood of Flagstaff's prosperity, are now its most anxious sellers. New regulations, cooling tourism, and rising utility costs have turned profit into loss. Many are panic listing, flooding the market with overpriced properties that no longer sell. Even developers are pulling back. Luxury mountain cabins and condo projects are being quietly shelved as lenders turn cautious. For decades, Flagstaff symbolized exclusivity, a high-altitude haven above Arizona's volatility. But in 2026, not even this city in the clouds is safe from gravity. Number 7, Tucson. Tucson was once Arizona's hidden treasure, the affordable alternative to Phoenix, wrapped in desert charm, culture, and university town energy. For decades, it promised balance. Big city amenities without the big city price tag. But that promise is unraveling. During the pandemic, Tucson's real estate market exploded, with prices climbing 55% in just 2 years. Now that growth has reversed, and fast. The city's median home price has fallen nearly 15% since 2024, and the number of active listings has doubled. The silent villain behind Tucson's fall is insurance. After years of flash floods, monsoon damage, and wildfire risk, premiums have tripled across Pima County. For some neighborhoods, annual coverage now exceeds $6,000, wiping out affordability even for longtime owners. A $400,000 home that once cost $2,400 a month to own now requires nearly $3,800 after insurance, taxes, and HOA fees. An impossible figure for a local median income of just $63,000. Families who stretched to buy during the boom are falling behind, while renters find themselves priced out by landlords trying to recoup losses. Airbnb hosts, once the pandemic's success story in Tucson, are also suffering. Occupancy has dropped below 50%, forcing investors to unload homes at major losses. Foreclosures are already up 30% year over year, and partially built subdivisions are quietly stalling as developers abandon unfinished projects. Tucson was supposed to represent balance, where affordability met opportunity. But in 2026, it has become the face of Arizona's affordability paradox. Number 6, Mesa. Mesa, the sprawling heart of Phoenix's east side, once symbolized suburban success. It was clean, safe, family-friendly, and growing faster than almost anywhere in the country. But in 2026, that growth has become its downfall. Home prices have fallen nearly 20% since 2022, and the slide isn't slowing down. Builders flooded Mesa with new housing during the pandemic boom, betting on infinite population growth. But the buyers never came. Projects in Eastmark, Gateway, and Power Ranch are now sitting on half-finished homes and price cuts that get steeper every month. Even longtime homeowners are feeling the pain. Insurance premiums that once cost $100 to $800 a year now exceed $5,000 for many properties. Combine that with 7% mortgage rates, HOA hikes, and property taxes, and the average family's housing costs have doubled in 4 years. Realtors call this a market frozen by fear. Homes sit for months without offers, and sellers chase falling prices in a race they can't win. Investors who once bought properties for rental have vanished, scared off by shrinking profit margins and declining rents. Local economists say Mesa's biggest risk is psychological. The city was built on the belief that housing always appreciates. But when equity turns to debt and optimism turns to anxiety, even the most stable markets can crack. Analysts predict another 10-15% drop by the end of 2026, wiping out billions in equity. Mesa's reversal isn't just a correction, it's a wake-up call. Number 5, Sedona. Sedona, Arizona's Red Rock jewel, was once a sanctuary for artists, retirees, and dreamers seeking desert serenity. But in 2026, that serenity has turned into financial stress. Once considered immune to volatility, Sedona is now witnessing the same painful correction. Median home prices, which soared past $950,000 in 2022, have fallen nearly 20% in 2 years. Luxury properties that once sold overnight now sit for months, even after 6-figure price cuts. The causes are layered: soaring insurance premiums, dwindling tourism, and short-term rental restrictions have collided to drain demand. Airbnb occupancy has fallen below 50%, and many investors who bet on year-round visitors are defaulting. Entire rows of luxury vacation homes now sit dark, beautiful but empty. Local families are also being squeezed. Property taxes have risen sharply and the cost of living has skyrocketed. Even longtime residents are being forced to sell as maintenance, taxes, and insurance overwhelm fixed incomes. The city's economy, once driven by art galleries and spas, is faltering. Developers who once pitched Sedona as the Aspen of the desert are quietly shelving new projects. Realtors call today's market a paradox: breathtaking beauty shadowed by economic fragility. In 2026, beneath those crimson cliffs, the cracks in Arizona's real estate dream are spreading. Number 4, Scottsdale. For decades, Scottsdale wasn't just a city. It was a statement. Golf resorts, multi-million-dollar homes, exotic cars cruising palm-lined streets. This was the Beverly Hills of the desert. The promise of endless sun and exclusivity made it one of America's most desirable zip codes. But in 2026, even the wealthy are feeling the chill. Home prices have fallen 18% in a single year. However, the deeper issue isn't price, it's the cost of ownership. Luxury insurance policies that once cost $6,000 now exceed $15,000 annually. Homeowners associations, HOAs, are levying 5-figure special assessments for storm repairs and infrastructure, and property taxes have risen nearly 30% since 2020. Even cash buyers are hesitating. Realtors report that high-end listings now sit on the market for over 200 days, forcing sellers to cut prices by hundreds of thousands of dollars. Those million-dollar mansions in DC Ranch and Silverleaf? Many are being quietly relisted below $800,000, and still they don't sell. Corporate investors and out-of-state flippers who once treated Scottsdale as a luxury playground have pulled back entirely. The demand that seemed bottomless has evaporated, leaving behind a trail of over-leveraged properties and anxious owners. But Scottsdale's fall is deeper than the numbers, it's psychological. The The city's identity was built on confidence, prestige, and the illusion that wealth could overcome risk. Now that illusion is crumbling. Number 3, Chandler. Chandler was Arizona's tech darling, the Silicon Desert. With semiconductor factories, soaring wages, and sleek new neighborhoods, it embodied modern prosperity. But in 2026, that prosperity is fracturing. After years of growth fueled by remote workers and corporate expansion, the market has turned sharply. Tech giants have frozen hiring and shifted operations overseas. The construction has slowed, and the ripple effect is spreading through every layer of the real estate market. Median home prices have already fallen 16%, with luxury builds in neighborhoods like Ocotillo and Fulton Ranch sitting unsold. Builders are slashing prices by $100,000 or more just to get buyers in the door. But even those discounts can't compete with 7% mortgage rates and rising insurance costs. The cost of living has exploded. Energy bills have soared, taxes have risen, and even high-income engineers are cutting costs. What once seemed like a comfortable mortgage has become a suffocating payment. Local developers say Chandler's smart city expansion backfired. There is simply too much supply and too little qualified demand. Investors are now renting at a loss or walking away from projects entirely. Analysts call Chandler's decline a warning for every fast-growing tech hub in America. In 2026, Chandler's fall might just become the first major correction of the Silicon Desert era. Number 2, Phoenix. The heart of Arizona's boom is now the heart of its reckoning. From 2019 to 2022, this desert metropolis was unstoppable. Home values doubled, bidding wars erupted daily, and out-of-state buyers treated every listing like gold. But the fire burned too hot, and now the flames have gone out. Median prices have fallen 15%. Housing inventory has doubled, and bidding wars are a distant memory. Builders who once couldn't pour foundations fast enough are now sitting on thousands of unsold homes in suburbs like Goodyear, Surprise, and Peoria. At the peak of the boom, Phoenix was adding more residents than any metropolis in America. But that momentum has stalled. High interest rates, punishing insurance premiums, and relentless property taxes have frozen demand. A city built on migration now faces the harsh reality of stagnation. A median home that cost $1,700 a month to own in 2020 now costs $2,900 or more. And that's before maintenance and HOA fees. Insurance rates have tripled, and buyers simply cannot keep up. Flippers who once made fortunes are bailing. Investors are liquidating rentals at a loss. Foreclosure filings have risen 20%, and analysts warn the slow drip could become a flood. Phoenix's decline won't be a fast collapse, it will be a slow grind. Month by month, prices slide, confidence fades, and optimism gives way to fatigue. By the end of 2026, much of the equity built during the pandemic will be gone. Number 1, Buckeye. And at number 1, Buckeye, Arizona's most explosive boomtown and now its biggest cautionary tale. For years, Buckeye was hailed as the next great American suburb. Developers promised futuristic master-planned communities, affordable homes, and endless expansion. Between 2019 and 2022, home prices more than doubled, outpacing every other city in the state. But that kind of growth always has a breaking point. In 2026, Buckeye's market is collapsing. Prices have already fallen 25%. Housing inventory has quadrupled, and the construction sites that once bustled with activity are now silent. Builders are offering $50,000 discounts, covering closing costs and even throwing in free upgrades, and still, they cannot sell the homes. The cause? Overbuilding and overconfidence. Developers built faster than the population could grow, assuming the migration from Phoenix and California would never slow. But it did, and the fallout is brutal. Compounding the problem are water shortages and infrastructure delays. Projects that promised parks, schools, and shopping districts remain unfinished. Buyers feel misled, and many are walking away. Entire subdivisions sit half-finished, their model homes surrounded by empty lots and weeds. Buckeye's fall isn't a hiccup. It is structural. It reveals what happens when optimism becomes denial and speculation outpaces sustainability. In 2026, Buckeye may not just be Arizona's real estate warning sign. It might be America's. From the mountains of Flagstaff to the overbuilt suburbs of Buckeye, The Arizona boom has hit its breaking point. This isn't just another market correction. It is a complete reset. Insurance hikes, water limits, rising rates, and exhausted buyers have turned the American desert dream into a desert reckoning. Thank you for watching Keynomics. The Arizona market is just the beginning. For more analysis that helps you understand the economic landscape, subscribe and turn on notifications, and see you in the next video.